Welcome to Chapter 2, where we focus on the foundations of cost accounting. In this section, we'll introduce key cost terms and concepts that are fundamental to understanding everything that follows. Grasping these basics will help clarify the purpose of cost accounting and set the stage for more detailed discussions in later chapters. Let's dive into the essential terminology and ideas that shape the way we approach cost management. A cost object is essentially anything for which we want to separately measure costs. Think of it as a specific item or entity that managers want to track expenses for. For example, a particular manufactured product, like a specific bicycle model, an engine part, or a smartphone unit, can be considered a cost object. By treating these as cost objects, companies can identify exactly how much it costs to produce or support each one. But it's not limited to just products. Services, customers, departments, or even projects can also serve as cost objects. Understanding what qualifies as a cost object helps organizations allocate costs accurately and make better financial decisions. When we talk about cost objects, we're referring to anything you want to measure costs for. This means cost objects can take many forms depending on your focus. For example, it could be a product like a car, where you want to track all the costs involved in manufacturing it. It could also be a service, such as office support, where you're measuring the costs associated with providing that service. Customers themselves can be cost objects as well, meaning you track costs related to serving a specific account. Lastly, projects, like a custom engagement, are also valid cost objects. The key takeaway here is that one fundamental concept of cost objects applies broadly. Virtually anything that costs money and requires tracking can become a cost object. This flexibility helps organizations understand and manage their expenditures more effectively. In this slide, we're focusing on the concept of direct costs within cost classification. Direct costs are those expenses that we can clearly and economically trace back to a specific cost object, such as a product, service, department, or customer. The important idea here is that if there's a clear and measurable connection, we classify that cost as direct. This helps us understand which costs directly contribute to a particular area of the business, enabling more accurate cost management and pricing decisions. When we talk about indirect costs, we're referring to expenses that are connected to a cost object but can't be traced to that object individually. These costs support multiple cost objects at the same time. Because of this shared nature, indirect costs are generally allocated across the different cost objects rather than assigned directly. This allocation is important because it helps us fairly distribute expenses like overhead, utilities, or administrative costs that benefit several projects or departments simultaneously. Understanding how indirect costs work provides a solid foundation for managing and controlling overall costs effectively. When we talk about cost classification, one of the most important distinctions is between direct and indirect costs. The key difference lies in whether the cost can be traced to a specific cost object in a way that's both convenient and economically feasible. Direct costs are those that can be directly and easily traced to the product or service. Examples include raw materials, direct labor, and component parts, basically, costs that are clearly linked to the production process. On the other hand, indirect costs are more about support functions that help the cost object but can't be traced easily or without incurring excessive expense. These include things like utilities, supervisory salaries, and factory rent. Understanding this classification is crucial because it affects how we measure and manage costs effectively in any business. In manufacturing, costs flow to products in two main ways based on how clearly they can be linked to a specific product. Direct costs, like materials and labor used exclusively for one product, are traced directly to that product. This makes it straightforward to assign these costs because the connection is clear and specific. On the other hand, indirect costs, often referred to as factory overhead, support multiple products. Since these costs can't be traced directly to a single product, we assign them by allocating based on a reasonable cost allocation base. Understanding this distinction between tracing direct costs and assigning indirect costs is fundamental in managing manufacturing costs effectively. Let's dive into how variable costs behave. Variable costs change in direct proportion to the level of activity. As activity increases, total variable costs rise, and as activity decreases, total variable costs fall. For example, if you look at this scenario, at low activity, producing 10 units costs $50. When we double the units to 20, the cost also doubles to $100. Doubling again to 40 units results in $200 in total variable costs. This consistent relationship holds true within what's called the relevant range. Common examples include shipping materials used per order, hourly labor that's paid based on hours worked, and fuel expenses that vary with miles driven. Understanding this helps us plan and control costs effectively as production levels change. Let's talk about fixed costs and cost behavior. Fixed costs are expenses that remain constant within a certain range of activity, meaning the total cost doesn't change even as production or activity levels go up or down. For example, whether your activity level is low, medium, or high, the total fixed cost stays the same. However, what does change is the cost per unit. As you produce more units, the fixed cost per unit decreases because the same total cost is spread over a larger number of units. Some common examples of fixed costs include facility rent, which typically stays the same month to month, insurance costs that are paid regardless of how much you produce, and management salaries, which don't increase with each additional unit produced. Understanding how fixed costs behave helps in budgeting and decision-making, especially when planning for different levels of production. Now, let's talk about cost behavior, which is fundamental to understanding how costs react to changes in activity levels. The key difference lies between variable and fixed costs. Variable costs change directly with activity. When output goes up, total variable costs increase. When output goes down, they decrease. Think of materials or direct labor costs that fluctuate based on production volume. On the other hand, fixed costs remain constant in the short term, regardless of activity changes within a certain range. These include expenses like rent or salaries that don't vary with production levels. So, while total variable costs rise and fall with activity, total fixed costs stay the same as activity changes. Understanding this distinction helps in budgeting, forecasting, and making informed business decisions. When we talk about unit costs, it's really important to understand what drives those costs. Unit costs don't exist in a vacuum, they change depending on the volume of production. As output goes up or down, the cost per unit can either rise or fall, so you can't just assume the cost will always stay the same. Another key point is that the same product can have different unit costs at different levels of activity. That means if you're comparing costs, you have to consider the context carefully. Always ask yourself what time period the cost relates to, what the production volume was, and what the cost is being used for. By keeping these factors in mind, you get a clearer and more accurate understanding of what unit costs really mean. This caution helps ensure you make better decisions based on the numbers. When we talk about unit costs, there are some common pitfalls to keep in mind. First, volume really shifts the math. For example, producing 10,000 units at $12 each might seem straightforward, but if volume drops to 5,000 units, the cost per unit can jump to $18 even if the overall spending doesn't increase. This shows how sensitive unit cost is to production scale. Another important point is that different products can distort averages. When we calculate a blended unit cost, it might hide the fact that one product is cheap to make while another is quite expensive. This can give a misleading picture of overall costs. Finally, short-run decisions can also be tricky. If we use full unit cost to evaluate a special order, we might reject business that actually covers incremental costs and adds to profit. Understanding these nuances helps us make better decisions when analyzing costs and pricing. Now, let's focus on inventoriable costs, which are also known as product costs. These costs are assigned directly to units of product and are carried in inventory until the products are actually sold. What's important to understand here is that these costs first attach to the products themselves. Because of this, they show up on the balance sheet as part of inventory rather than immediately being recorded as an expense. It's only when the products are sold that these costs move from the balance sheet to the income statement as expenses. This concept is fundamental because it helps us accurately match costs with the revenues they generate, providing a clearer picture of a company's financial performance. Now, let's talk about period costs. These are costs that are expensed in the period in which they are incurred, meaning they are not included in the product inventory costs. Essentially, period costs are not tied directly to the production of goods. Common examples include administrative costs, such as office salaries and utilities, marketing costs which cover advertising and promotions, and selling costs like the expenses related to distributing the product. Understanding period costs is important because they affect our financial statements differently than product costs, giving us clearer insight into the expenses associated with running the business rather than producing inventory. Now, let's dive into cost classification, which is fundamental for understanding how costs behave and how they are recorded in accounting. First, we have inventoriable costs. These are costs directly attached to the products and stay with the inventory until the goods are sold. This includes direct materials, direct manufacturing labor, and manufacturing overhead. All these costs are included in the cost of inventory on the balance sheet initially. Then, once the product is sold, these costs are recognized as the cost of goods sold on the income statement. On the other hand, period costs are not tied to the production units but to a specific time period. Examples include marketing and advertising expenses, distribution and shipping costs, administrative expenses, office salaries, and corporate rent. Unlike inventoriable costs, period costs are charged directly to the income statement in the period they are incurred. Understanding this distinction is crucial because it affects how costs flow through financial statements and ultimately impacts profit measurement. Here, we're looking at the flow of inventoriable costs, which track how costs move through production before they're recognized as expenses. It starts with raw materials. These are the purchased inputs that are waiting to be used in production. Next, as production progresses, these raw materials combine with labor and overhead costs, and this stage is called work in progress. Once the product is completed, it moves into finished goods, meaning it's ready for sale. Finally, when the product is sold, the associated costs are recorded as cost of goods sold, which is when the expense is actually recognized. This flow helps us understand how costs accumulate and transition from inventory to expense over time. Let's talk about inventoriable costs and how they move through the production process. These costs start with raw materials, which are the basic inputs needed to make a product. As production begins, these costs move into work in process, meaning the product is being actively worked on but not yet finished. Once the product is completed, the costs transfer into finished goods inventory. It's important to know that these costs remain on the balance sheet as an asset until the product is sold. Only when the inventory is sold do these costs become an expense, known as the cost of goods sold. So, the warehouse inventory you see represents accumulated costs from materials, production, and finished goods, all waiting to be sold. This flow of costs is fundamental to understanding how manufacturing expenses are tracked and reported. Now, let's talk about period costs and how they flow through the accounting system. Period costs, which include selling, distribution, and administrative expenses, are different from inventoriable costs because they do not become part of inventory. Instead, they bypass inventory entirely and are recorded directly as expenses in the income statement during the period in which they are incurred. This means they have a direct path through the accounting period, without passing through raw materials, work in process, or finished goods. Because these costs are expensed immediately, they reduce operating income right away. Understanding this flow is crucial because it affects how we report costs and measure profitability in a given period. When we talk about cost accounting methods, it's important to understand why product costs are computed in different ways. First, different purposes require different cost classifications. For example, the same cost might be categorized one way for financial reporting and another way for internal analysis. This helps meet varying needs depending on the context. Second, managers need different types of cost information to make informed decisions. Whether it's pricing products, planning budgets, controlling operations, or deciding whether to outsource, each decision relies on a specific perspective of cost data. Finally, there's a clear distinction between financial reporting and internal management needs. External financial reporting follows strict rules and demands consistency, while internal management focuses on relevance and usefulness to drive better decisions. Understanding these differences helps us appreciate why cost accounting uses varied methods tailored to distinct purposes. When we talk about product costs, it's important to recognize that different methods serve different purposes. The same product can have multiple cost sets depending on why we need the information. For financial reporting, costs typically include direct materials, direct labor, and manufacturing overhead. These are essential for calculating inventory values and the cost of goods sold accurately. On the other hand, when we look at costs for internal decision-making, the focus shifts. Here, we consider relevant variable and fixed costs, and sometimes non-manufacturing costs are included as well. This approach helps with pricing decisions, assessing efficiency, and shaping overall strategy. The key takeaway is that there isn't a one-size-fits-all cost figure. The way we measure costs changes depending on what decision we need to support. Understanding this distinction ensures we use the right cost information for the right purpose. Cost accounting starts with identifying the cost objects, which means deciding exactly what you want to measure. This could be a product, a service, a customer, or even a department. Next, we classify the costs by determining whether they are direct or indirect, and whether they're variable or fixed. This classification helps us understand the nature of each cost and how it behaves. Then, we assign costs appropriately by tracing direct costs directly to the cost objects where possible, and allocating indirect costs using a logical, fair method. Finally, we use these costs for their intended purpose, such as supporting pricing decisions, planning, controlling operations, evaluating performance, and making strategic choices. This simple but structured sequence transforms raw spending data into valuable insights that drive better decision-making. Now, let's look at how the cost accounting framework moves from concept to practical use. It all begins with identifying the cost object, which could be a product, service, customer, or even a specific activity that we want to measure. Once we have that, we carefully classify costs as either direct or indirect. This is crucial because direct costs are traced directly to the object, while indirect costs are allocated, ensuring accuracy in cost measurement. Next, we analyze the behavior and timing of these costs. This means distinguishing between variable costs, which change with production volume, and fixed costs, which remain constant regardless of output. We also consider whether costs are inventoriable, linked to products and inventories, or period costs, which relate to specific time periods. Finally, the information gathered is used for important business decisions, such as pricing strategies, planning operations, controlling expenses, and evaluating performance. This is where the framework turns into action, guiding reports, operational processes, and critical choices that impact the organization's success. Now, let's focus on the managerial application of cost accounting. The key idea here is that cost accounting is not just about producing reports or summarizing past performance. Instead, it actively supports decisions that help improve performance. Managers use cost information in several important ways. First, by tracking actual costs against expected costs, they can better control expenses and identify areas where things might be going off track. This helps in maintaining tight cost control. Second, cost data is essential for setting prices that accurately reflect cost behavior, profit margins, and market objectives. Third, it helps pinpoint inefficient activities within operations, enabling managers to redesign processes and enhance overall efficiency. Finally, cost accounting informs strategic decisions about products, customers, processes, and how resources are allocated, ensuring that the organization focuses on the most valuable opportunities. In summary, cost accounting is a powerful tool for making informed managerial decisions that drive better business outcomes. This chapter really focuses on building a solid vocabulary to help us analyze, classify, and use costs effectively. First, we talked about cost objects, which are basically anything we want to measure costs for, whether that's products, services, departments, or even customers. Then, we distinguished between direct and indirect costs. Direct costs can be directly traced to a cost object, while indirect costs have to be allocated since tracing them exactly isn't practical. We also covered variable versus fixed costs. Variable costs change as the level of activity changes, whereas fixed costs stay constant within a certain range. It's important to use unit costs carefully, keeping in mind that a unit cost is an average and doesn't guarantee the same cost for each additional unit or decision. We looked at inventoriable versus period costs too. Inventoriable costs are attached to products and stay there until the product is sold, while period costs are expensed during the period they're incurred. Finally, we wrapped up with the cost accounting framework, where different decisions require different views of costs, highlighting how cost accounting serves both reporting and management purposes. To wrap up this chapter, we've established that understanding cost terms is crucial because the decisions we make rely heavily on knowing what cost we're measuring, why we're measuring it, and how it's classified. These distinctions form the foundation for everything that follows. In the next chapter, we'll take these concepts a step further by applying them to real-world cost behavior and analysis. So, keep in mind that a clear grasp of these cost terms and purposes is essential as we move forward. This concludes Chapter 2, our introduction to cost terms and purposes.